thank you so much for coming on the show. And
Great to be here.
I think this is obviously a very big moment for you, John, because you realize by you being on the show, you know that your next step is you're going to be CEO of Northwestern Mutual, right?
I think you had a hand in that for Tim Guerin, our current CEO.
Yeah, I mean,
you single-handedly got him elevated, I think.
It's clear that being on Advisor Lab has a profound impact on people's careers. So I'm going to just be the first one to say congratulations already.
Thank you.
I love Tim,
Derek.
and I'm sure he's going to be great. But now you are, where are you based out of?
We're in Milwaukee, Wisconsin.
Right, and the Brewers are still in it, right?
The Brewers are in it. So this is, let's see, we're talking today. It's game 2 of the NLCS, but the Dodgers, Derek, they're a powerhouse. We'll see. It's been a fun run, but we'll see what happens over the next week.
Well, I'm a New England guy. My Red Sox were gone a long time ago, but I married a Philly girl, and the Phillies did not do well against those Dodgers. So I'm pulling for you guys big time.
We both, I think, are running into a buzzsaw.
Yeah, they're really, really tough. I'm super excited when I had Tim on. And obviously, anytime I talk to your firm, you guys are great partners with my firm, Scion. But I started my career as an insurance agent with Equitable Life or AXA. Now it's back to Equitable. And I mean, you're responsible now for a lot of things, but obviously running 21,000 advisors. You're the chief field officer, executive. Yeah. By the way, congratulations. I know this is a recent
thank you.
Promotion and part of your career trajectory. But I remember back then, and I probably said the same thing to Tim, but like we were one of the first, I thought, that was trying to blend this financial planning with portfolio management.
Yeah.
It was back in the old days. It was, you sold life insurance. It was either whole life or term. And then you could do some things that were more exotic with your senior executives, the golden handcuffs and all that, and COLA. But we were running around this thing called Financial Foundations. It was some software, and it would do the whole analysis on how much insurance you need and how much savings. And then we would bring out investment products, insurance, mutual funds. And I was only there because I thought, wow, I'm not just selling life insurance and clearing out a room. I'm selling like financial planning. And that was really exciting. And to see how it's evolved, it seems like you and your firm have really been leading that evolution. And I'm just wondering right off the bat, like, talk about how you guys saw it. Like, what were some of the ahas? Because there's a lot of big insurance companies out there you compete with, but they're not doing it like you guys are, right?
Yeah. Well, we certainly think everyone is talking about financial planning. It's the buzzword, whether you're doing true cross-product integrated planning or not. It's how we're all describing how we go to market. Yeah. I'll admit something, Derek, though. Initially, when we got into the investment business, a little over 25 years ago, really in earnest, we were doing that more as an accommodation to our advisors who were telling us, hey, when we're in front of prospects, when we're in front of our clients, we need to have more to offer in order to compete, in order to be at the center of their financial life. So planning, I wish I could say, was this grand strategy that we had from the jump. Really, it was our advisors telling us, this is how we're going to differentiate ourselves and become the advisor, not the insurance advisor. In the lives of our clients. Sure. And that's snowballed. And now we really do go to market as full integrated financial planners. More than half of the households that we work with today will have a full integrated financial plan. So they've got insurance and investments. And what we find is that when we do both, we have greater client stickiness, greater asset stickiness, insurance persistency. It all works together when you wrap it in a plan. And, of course, most important, the client gets a better outcome.
Well, the challenge, talk about that now, because now you're really competing with the same advisors that Merrill Lynch and all the other big wirehouses and independent LPLs, what have you. You're right in the mix, because back in the day when I was doing this, it was like a different type of person went insurance. Yeah. It was a different sales pitch to him from his career. And now you're really able to go toe to toe with all these firms and go out there, and you're responsible for obviously growing the ranks, right? And we'll get into the recruitment challenges too, because I know you were quoted in Barron's, and I want to talk about that. But just from the perspective of skilling these folks up, getting them educated on all the different things. They got to know advisory, they got to know insurance, and insurance in itself is a beast,
Yeah, it's
right? If
complicated
you're going to
for
do it
sure.
right, not just run some hypo and sell a guy
Yeah.
$500,000 of variable life. How do you guys build that? It's amazing.
Yeah, that's it. I mean, that is the question, and that is kind of our big focus as a function inside of Northwestern Mutual is how do we build a platform that can not just develop the next generation of advisor, but really serve advisors across a whole spectrum. We still have out of our 21,000 person field force, we still have a good number of advisors that I want to focus on risk protection, and that's going to be my specialty. And I'll bring in a partner or a team member to help solve for the balance of the financial plan. So we need a platform that works for them. On the other end of the spectrum, we have advisors that have large books of business under their management that really decide, I don't want to get in the mix of talking about their health and their insurance needs. I'll bring in a partner that can do that. So we've got to have a platform that kind of serves both ends of the spectrum, and then our kind of base case, which is the true advisor to bring it all together. But training and developing an advisor to be able to do all of that is much more difficult than 20 years ago. We were giving people, the one card system on how to do prospecting, how to get leads, how to place term DI, and maybe a whole life product. We could get someone up and running in 3 weeks. Now we want everyone that starts with Northwestern Mutual to be licensed. We need 6 and 63 at a minimum. Got to have, of course, your state life and health as well. But the kind of startup cost and startup time have grown significantly. But I think it's given us greater capabilities in these new or next generation advisors we're bringing forward.
Do you feel like Northwestern Mutual is a better situation for a young, promising professional getting into the business than starting at XYZ, wire, or independent because of the importance you have to place on training, because there's so much that you're bringing to the table? Like, I know as a young man, I went to Merrill Lynch. They were like, call me in 3 or 4 years. I went to Janney Montgomery Scott. They were like, call me in a few years. The insurance folks embraced me, and it was hey, write down the 50 people your family knows and let's go call them.
Yeah. Yeah, it's certainly a part of the conversation up front, right? Do you have enough of a network to build a clientele?
Right.
But yeah, I'm biased, I admit it, but I do think that we provide a partnership where young talent could come in and they can be in business for themselves. They build their own equity value in their own business, but they're not by themselves, right? They have the backing of a large company that can provide both a local and a national training program, help on education and credentialing, training schools that can specialize in certain markets, practice management support for building your practice over time. It's kind of trying to find the sweet spot of, on-demand and a la carte education and training opportunities, yet preserving the sort of entrepreneurial independence that I think really is one of the most attractive dynamics of our industry.
You had mentioned in Barron's in June, in that piece about recruitment challenges, that I guess 3,000 advisors, I think,
That's right.
10 years, there'll be, I don't know, a 20% that'll be still with the firm at that point based on the data from your company. But if they get past 5 years, your stats are like 96% retention.
Right.
So I don't know if maybe you can speak to it or not, how that compares relative to your peer group. And what keeps them after that 5 years? Like, is that something you've thought about? Like, well, how do we replicate that so that we can keep them a bigger percentage over the 10-year stretch? Is it financial rewards they hit, certain bonuses or reimbursements? And, how do you guys approach
for
it?
sure. Is there different training we need to provide or connection to the company or support we can provide that helps create greater stickiness? Yeah, you quoted the numbers right. That's going to be true for us this year. We'll recruit new to the financial advisor career in the neighborhood of, it will end up being 3,400 to 3,500 new financial advisors. That compares to our 21,000 total field force. And in 5 years, we expect about 20% of those individuals will still be with us working and serving clients in some capacity. When we benchmark ourselves across the industry, unfortunately, we're not terribly different than firms that have a somewhat similar model.
Right.
A model where you don't have a W-2 full-time employee, but you do have, in our case, a 1099 on our wealth management business, and then something kind of funky you may recall from your life insurance days, the statutory employee on the insurance side of the business. So it seems to be in line with the industry. And I think while incentives matter and providing more incentives to kind of increase stickiness may help, there's today an infinite opportunity for wealth creation and income as a financial advisor. So there's plenty of incentive. I think the industry, and Northwestern Mutual included, can do more to help the next generation of advisors figure out how to reach out to and acquire the next generation of client. The next gen does not interact with they don't interact with human beings the way you and I did, perhaps when we were starting our careers. And I think, ourselves included, we have got to do more to arm and equip our new advisors on different ways of finding leads, making the connection, and earning their trust in an environment that looks a lot different than it did even 5 or 6 years ago.
I run a sales team, and I was just saying this morning. If you don't want to be replaced by the digitization of the marketplace, you have to bring value, and it can't just be a fat card with 5 morning stars. I mean, you have to bring something else to the table, because advisors can chat GBT this and pull it up anywhere they want. And that goes for the insurance, right? And I even know that your company obviously has some different digital offerings to consumer and to complement obviously what your distribution force is doing, right? You have to have your feet in both to some extent. But for us as people who are in the relationship business, because that's what we're in, you have to teach your team how to build relationships and how to bring value, because the human being will always, in my opinion, want that personal touch. Not all of them. There's going to be certain segments of the market that won't. But there is a market. If anything, robo-advisor taught us is people aren't going away in the money advice, insurance, financial planning business. But you're right. We as sales leaders have to equip our team to better know how to do that, right?
It's not replacing us. I think you've nailed it. It's about how do we complement our capabilities with digital tools or assets that can help us engage with the next gen in the way they want to be engaged. I think you've nailed it. It's a risk of displacement if we think that knowledge is our differentiator. Knowledge is a common good now. Everyone can learn anything about any of the products. They could assemble their own financial plan. I think they want the relationship. I think consumers need the kind of steady hand to help them take action. And you said it right. They're looking for the human touch. Frankly, they also, whether they know it or not, they need a human being to keep them committed to that plan long term. We did a study earlier this year. We found while over a third of the respondents said that, okay, I'm comfortable working with a digital tool or even AI in my financial planning, about half of the respondents said, I would prefer have a human being that has some AI or digital capabilities embedded into the work they're doing with me. And I think, those numbers are only going to grow over time.
That's a fascinating takeaway from that. Let me switch gears a little bit for you, because the markets have been hot, as we know. This has been, I'm older than you, but I remember being a financial advisor in Fifth Avenue, New York City at Merrill Lynch at the top of the bull market in '99, and a lot of similarities. Well, whenever you have a bubble, you have them. There were all these new companies that were going to change the world, and it really did. The internet did change the world, but there were a lot of winners, a lot of losers. This isn't a question really about the AI bubble and all that, and how do you tell your advisors to handle their clients. It's more about the overall just opportunity sets, because you've got the AI thing, you've got Bitcoin, you've got 1,000 ways you can invest now. There's so much. In a lot of ways, it makes the need for for a professional advisor and his or her advice to you even more important because you need someone to sift through the noise. Private markets are also part of that. And,
For sure.
Cerulli, I'm reading this, recently projected the U.S. financial advisor allocation to less liquid private market strategies could grow from 1.9 trillion to 3.7 trillion by
saw the same thing.
2029.
Yeah.
Even if it doesn't get to three, that's a lot of money. Given that tailwind, talk about Northwestern and how you're positioning yourself from the private markets, real assets, and so forth.
Yeah. What an amazing opportunity we have right in front of us, right? To have the retail client be able to diversify their long-term investments and savings into the private markets, whether it's private credit, real assets, you name it. And I think it's been to the consumer and the retail investors' benefit that we've been able to sort of democratize and build bridges of access, as you've done, into those asset classes. I think as we talk about it with our clients and with our advisors, the inclusion of a non-correlated asset relative to the rest of the portfolio is a really healthy kind of complement to the balance of the advisory assets. Now, candidly, we think about making sure you've got a foundation of risk protection. If you're closer to retirement, you've got embedded guaranteed income as well. But we see those assets, which traditionally are kind of risk-based assets, as providing an ability for you to stay invested, stay diversified, hold asset classes that may be less liquid, may have less of a market opportunity over longer periods of time. So we're adding more alternatives and illiquid alternatives into our retail offering for our advisors. Now, of course, we want to make sure they're educated and have the training. So we're putting together more training and support for our advisors. But we think there's a massive opportunity. I don't know, like you said, if it's 3+ trillion or not in a handful of years. But for us, we look at our retail assets. Alternatives are they're a little less than 1% of our total AUM. So we've got a lot of room to run there.
Well, it must be interesting, and this may or may not be popular, or my bosses or whomever, but do you think of insurance as an alt? And do you have that situation where advisors are like, I mean, they own something non-correlated. They own insurance, right?
Yeah.
I mean, I've always felt like insurance, and now there's a whole market where you got a secondary or aftermarket where you can buy people's insurance, and funds have been doing it for years, right?
Yeah.
In its own right, it is and quite frankly, I was just reading cat bonds are going through the roof right now.
Right. Yeah.
Right. Which is basically a total insurance play.
Yeah. To wrap it.
So, a lot of ways, you guys have been in the insurance business before everybody was even in it, in a retail private wealth.
Yeah. I mean, so I think you're right on. We describe for our advisors, and we have a tool in their planning tech we call comprehensive asset allocation. That includes, if you have a permanent insurance product, the internal cash value of that product as a part of the overall asset allocation. It allows you then to look at your total portfolio,
That's cool.
including that kind of illiquid alt, if you will. And then you can dial the rest of the portfolio accordingly, knowing you've got that really as an asset in your overall allocation.
Is that the PX planning platform?
So inside, yes, we built our own planning tool. We call it
talk
PX,
about that, because I thought that was neat.
Yeah. So, we were like everyone else for a long time. We were using third-party industry tools and leading tools. They did the job for us. But what we were finding is that the owners of that technology, they're kind of changing hand every 5 years. There's a different private equity owner of the tool. We found that in a world where we wanted to be a little more dynamic in what products we were showing, in how we integrated insurance and investments into the allocation, it was harder to get a third-party provider to invest in the tech to do it, because frankly, there weren't a whole lot of other clients that were asking for that integration, right? They had a lot of insurance-only clients, a lot of investment-only clients, not as many that were doing both together. So we decided we needed to venture out and build our own capability. That launched 7 or 8 years ago. It's now our only core planning tool. We use other tools like Holistic Plan and Y charts for some kind of specific tax support. But that PX tool can illustrate both insurance and investments, do the asset allocation, show the retirement income, and then help us on the sequence of drawdowns for kind of distribution of income and retirement as well. The latest feature is this comprehensive asset allocation where you can show everything as one total portfolio.
And I'm assuming there's a way that you can show the tax benefits, right? Because that's obviously been a massive part of the benefit of insurance planning is the taxes. And I wanted to ask you, you've been doing this how long?
I've been here 20 years now.
Okay. So, I mean, taxes are never going to not be important. So it would be silly of me to ask how much more important are taxes than they were 20 years ago. But from a planning standpoint and from a competitive standpoint, I'm like insurance, not only does it create wealth, it preserves wealth, right?
Yeah.
Minimize taxes, and it's a low correlation play. There's so many different ways to. I sound like back in my days when they were recruiting me, and I'm like,
I love it.
How do I want to sell a mutual fund where if I don't sell it, I still pay taxes? This is way better.
Right.
How did this whole aspect of it has to be a big part of what you show in PX planning.
It's a huge part of how we describe the value of having it as a component of your overall financial plan. EY did a study in 2021, and they just re-upped the study this year with another product line, and they showed that the inclusion of a life insurance product with some form of guaranteed income, an annuity product with investment accounts, if you put all three of those together, same dollars invested or saved, the client has, based on their Monte Carlo analysis, client has higher net worth prior to retirement, has higher guaranteed income in retirement, and a higher post-tax legacy value at the end of life. It's hard to bring all three of those things together. It's hard to illustrate it. Let's be honest, like annuities and insurance aren't as interesting to the consumer today. They're not as fun to talk about. And, there's a risk of them kind of giving you the stiff arm. But you can truly deliver better outcomes. And EY has kind of independently proven this when you put them all together. So that's a lot of what we're trying to illustrate in this planning tool.
Yeah, well, people can be educated on it. They're going to find out there's nothing that's not sexy about the kind of wealth preservation and tax benefits that you can get from these.
Right.
Done with the right company, with the right insurance company, right? And
sure.
There's a lot to that to be said. Let's talk a little bit about this. Right, we've got the $80 trillion wealth transfer. I'm sure, offhand, what's like the average age of your advisor at Northwestern?
Yeah. So the average age of our advisor, get this, 39 years old.
No way, because the industry is around 56, I want to say, or 60.
Whatever you read. Yeah, 56, 57. That's kind of what we read as well. Yeah.
So you guys are young.
Huge kind of vitality advantage for us. Part of that is because the average age of a new advisor recruit for us is 28. So we, to our earlier part of our conversation, we do target a younger demographic to kind of bring them in and train them earlier in their professional career. And as a result, we tend to have a younger field force overall, and that tends to bring us a younger client. The average age of a new client to Northwestern Mutual in 2025 is 32 years old.
No kidding.
So our strategy long term is that we can bring in the client early. We can secure the foundation of their financial plan with risk protection, start their long-term retirement savings. Then as they grow, we can become more wealth focused as they're growing in their in their income and in their savings needs. And then later in life, of course, we're solving for more complex estate, long-term care, retirement income distribution needs. But the lifetime value of a client for our advisor then hopefully is much higher, and the value we can provide for that client is much higher.
Yeah, your runway is just so much better. The long-term ROI on that is going to be phenomenal. There's no question about it. With respect to the older generation and that legacy planning, how does Northwestern help with that process? I mean, I'm sure you want to keep it in-house and find a marriage within the sales force, right?
Yeah.
Talk
it's
about
a huge,
that.
Huge topic across the industry. where are all the advisors that have been doing such great work for their clients for so long? Where are they going to find, the right next gen advisor to take care of those clients, and where are you going to be able to realize the value of their life's work? It's a big topic for us at Northwestern, even though we don't have the same kind of demographic histogram as the rest of the industry. We don't want our advisors who are 39 years old thinking about that, right? We want them focused on serving their clients, bringing in as many new households as they can every year, and trusting that when they get to that point in their career, they're gonna be taken care of. So our advisors at Northwestern, right, they own their own business, so they have an opportunity to sell their book of business. We provide, and this is relatively new, we provide a program from Northwestern Mutual where we will give very favorable capital to other advisors or their own successors inside of their team to purchase the equity of that business from the owner.
Nice.
And we just launched a program where we got $1 billion of capital from our board to invest into advisor practices. So we've been able to say to our advisors, hey, listen, when you get to retirement, we've got the capital to make sure that there's a great buyer that we can make a marriage with inside of our ecosystem. And if we can't find a buyer, we're happy to help broker it, take it down, and we can distribute out to other advisors.
Well, that's so smart. I mean, you have to make that kind of move now and reinvest back into your advisors' businesses. And it's amazing to see how much attention and capital the whole overall private wealth space has attracted from the private equity money, in the RIA space and the broker dealer space. And obviously they're investing in insurance all the time. That's, just a result of the clear benefits of your business, right?
Right. The attractiveness of retail wealth management, sure. The strong recurring revenue, the kind of persistency of clients over time. Look, if I was a private equity investor, I'd be looking at our industry too. I think some of the core challenges, though, is you still need revenue producers. Businesses that aren't growing organically simply aren't worth some of the headline multiples, I think, that we hear that are commonplace. So you need to make sure you've got the next generation of revenue producers. And a lot more has to go right for a business that's sold at 20 times earnings and a business that's sold at 10 or 15 times earnings. That organic growth is certainly part of it.
Yeah, you're right about that. The headline, that's a good way to put it, because you really don't know until you get into the business and start looking at each advisor line item by line item and their revenue, which I guess is a good way to finish, because I have a massive amount of the audience that we have are our advisors, independent insurance, RIA.
Yeah.
And I'm sure a great takeaway from your vantage point, it's invaluable considering how many advisors you touch. Thinking about the top folks, is there one or two takeaways from what they do that either no one does or they just do it better, that your garden variety 28-year-old with $80 million to your guy who's doing $5 million a year in GDC can take away and apply to their business?
Yeah. Well, probably two things that come to mind. Those top advisors, at least in our ecosystem, I think one of the things that separates them is they're investing in unbelievable talent around them. Talent that not only has some specialization, but talent that knows how to build and maintain relationships and be of service to their clients. Some of our top advisors are now hiring concierge managers from the hospitality industry to come into their firm and kind of be the leader of client relationship management and client hospitality. And like you said earlier, we're not going to differentiate ourselves within our industry with product and with knowledge as much as we have in the past. It's the relationship, the depth of the relationship, that I think really is going to separate a good advisor and a great advisor. Our best figured that out a while ago and have made big investments in talent around them. And the other nod I'd have is back to our conversation around planning. Our very best are doing integrated planning for every client. They're not looking at a high net worth client and saying, I'm just going to grab the assets and not worry about taking them through the arduous, kind of uncomfortable underwriting process for insurance. They're not just selling a quick insurance product. they're really delivering the client the entire value proposition that I think delivers better outcomes for the client, but for the advisor, creates stickiness of the clients, stickiness of the revenue, better leads and referrals from those clients. It kind of creates this virtuous cycle of success for them.
Well, that's perfect. John, thank you so much for coming on the show. And I hope you don't forget us when you're CEO and we can get you back on in the future.
Yeah, well, apparently it's, yeah, I'll let you know it was your doing again. Yeah, Derek, I really appreciate it. As I said, I've been a long time listener. I love what you do. I look forward to connecting with you again in the future.
Awesome. Appreciate it.
Thanks, Derek.
This video is for informational purposes only and should not be considered or relied upon as investment advice. It may not be copied, quoted, or referenced without Scion Investment's prior written consent. Do not rely upon any opinions, predictions, or forward-looking statements contained herein. The views expressed do not constitute an offer to sell or a solicitation to purchase securities, nor do they constitute the endorsement of a particular asset class or investment strategy. Neither Scion Investments nor its affiliates and/or subsidiaries warrants its completeness or accuracy. Certain information contained in this video may constitute forward-looking statements that may be inherently unreliable, and actual events or results may differ materially from those reflected or contemplated herein. Scion Investments expressly disclaims any obligation or undertaking to update or revise any information included herein. The views expressed by the guests or participants are their own and do not necessarily reflect the views of Scion Investments, LLC, or any of its subsidiaries, officers, or staff. Please be aware of the real risk of loss in following any investment strategy. No investment strategy or asset class referenced herein is intended to be construed as investment advice. You should make an independent, informed decision regarding any investments or strategies only after reviewing all relevant offering or disclosure documentation with your financial professional, and after considering your objectives, risk tolerance, and best interest before making any investment in any financial product. Registered personnel should review any business development initiatives addressed herein with their respective compliance and legal departments. Coverage of such topics should not be construed as compliance or legal advice. It is at the discretion of each respective firm if such practices are consistent with firm policies and procedures.